I think like the community in Bittensor is full of like young, brilliant people, and they're very motivated to deliver super competitive results. A year ago, many of these models didn't exist, right? When we were here in Toronto last year, or when I was here speaking at the same Google office, DeepSeek didn't exist.
It did?
It's pretty mind-blowing how much has happened since
Wow.
then. January 20th was a huge moment for the world because we started to see this hedge fund in China actually outcompete Western labs with a fraction of the cost. And if you recall,
Right. Nvidia collapsed.
January 20th was a day when there was a massive correction in public markets overall, actually. It basically creates maximum kind of distribution and propagation of this technology without any friction, without, you don't need anyone's permission to do those things. And I think it's extremely profound what Bittensor represents. James, how's it going?
Good. So this is our first live TaoPod.
Yeah, live in person.
And here we are. We're at Toronto. Just yesterday, we were at Google Toronto where I spoke. You spoke last year, right?
I did, yeah. I was there in, I believe it was August or September last year. I can't remember, but yeah, it was a year ago.
And we saw Targon speak yesterday. We saw Dippy, one of the other subnets of Bittensor, speak. We had dinner. There was the Ridges was there, and a bunch of subnets were there. So I myself, I learned, you probably know everything already. I learned so much talking to each one of these subnets one by one. It's really just such a pleasure. I learned so much each time.
Yeah, no, me too. I think like the community in Bittensor is full of like young, brilliant people, and they're very motivated to deliver super competitive results. And obviously they harness these miners that are all over the world competing and delivering open commodities. And yeah, the Google event was pretty fascinating because Manifold presented Targon, which is a compute subnet, and Rob Myers from Manifold is the CEO of Manifold, and he was actually one of the first Bittensor miners from early 21, talked about the financialization of compute and basically creating these liquid compute marketplaces where you can create all kinds of very expressive financial instruments. What if you could basically create options markets around compute? Or
So what would that mean? Like I can basically buy a call that compute pricing will be higher in the future?
Yeah, so imagine like the perfect pricing mechanism for any asset really requires the most expressive financial wrappers of that asset, right? If you're buying real estate, you have this notion of mortgages and lending. You can do collateralization. It's an asset that has a yield, long-term yield-bearing kind of feature where the asset improves over time. But compute is very different because it's depreciating, because we have newer compute models coming out all the time, newer chips. Nvidia is producing better processors on a regular basis. And so I think what Rob's premise was, which is really interesting, is how do you perfectly price compute in a way that you really know the cost as accurately as possible? Right now, the hourly rate of A100s, H100s, H200s, and now B200s, and the future generations of NVIDIA chips are priced very asymmetrically relative to market supply and market demand. And the prices are different. If you look at the prices on CoreWeave versus Lambda Labs versus Together AI, and like obviously all the cloud providers, Google, Azure, Amazon, and other cloud providers, the prices are all always very different. And they're different depending on maybe software that different cloud providers add on top of the compute that you're provisioning, some orchestration layer or some, networking feature or whatever. And I think Rob's premise is that if we could create these permissionless markets that would very finely and granular price compute, we can better discover price optimality of the resources that people are spending so much money on. I mean, the fastest growing businesses in history these days are these compute companies. And most of that value is getting accrued back to Nvidia, right? Because they have these really significant margins. But
Yeah, and can I ask, what's one NVIDIA H200 cost?
I think right now, if you were to buy one, it's $30,000 or so dollars. And I think that price is declining because there's more supply of H100s, H200s on the market. I think if you look at the hourly rate, it's a very wide range. A lot of providers charge per hour in the $2.50 to $3 price point, sometimes higher. There's a new way of consuming H series compute, which is the Hopper series chips, and even the Blackwell chips, which are less available, where you do it in more of a serverless container-based way, where you actually take minute level utilization of that compute resource and price it a little bit higher but you're more granularly pricing the access to that compute for specific applications that might only need it for a few minutes or 10, 20 minutes or something for running in containers. And that's a pretty common paradigm and something that Targon enables, something that Shoots is also doing on Bittensor. And so those prices tend to be higher. So if you average them out over the course of an hour, it could be $3, $4, $5.
And what does Targon charge?
I think Targon actually has the least expensive price for hourly rates of H200s. I think in the world, I think their pricing is in the close to $1.20, $1.30 range.
And they're
Really low.
and they have access to how many, let's call it H200s or equivalent.
I think they have a couple thousand H200s on their sub.
So let's say 2,000 times 30. So that's the equivalent of $60 million. And they didn't spend a dime on that, right?
Yeah, the miners for Targon basically provide that compute in exchange for basically accessing the alpha token and getting rewarded in the alpha token as well.
So who is a miner? Like, who has excess Nvidia GPUs that aren't running on any problems that they can just say, hey, Targon, you could use our resources in exchange. We'll get the Bittensor alpha tokens that you emit.
Yeah, it could be data center operators that have Slack available resources that they're not using for training or inference. It could be someone that says, I was able to find a provider in some colo facility or some cloud somewhere that's offering a price point that I think I can arbitrage and get a higher payment or a better reward represented in the alpha token of Subnet 4, which is Targon. Plenty of startups that raise venture capital, they take that money and they actually buy the GPU compute to train models and to build their own AI products. And in a lot of cases, the compute that they purchase is very underutilized. And similar, if you have a house, if you have a car, you might use Airbnb or VRBO or something to rent out a room. If you have a car, sometimes you might use like one of these rental services like Turo.
So Targon's like the Uber of compute. They have cars, which are like their data center, or they have drivers that are like these data centers who have excess compute, which is like the extra seats. And then Targon they basically, without raising $60 million, I don't know how much they raised. Let's say they raised zero. They basically use the Bittensor reward system to reward miners who have contributed $60 million worth of compute. And then they're able to go out, and because they paid nothing for it, essentially, they can charge $1.20 an hour versus the $3, $4 an hour that, I don't know, Amazon charges or CoreWeave charges or whoever.
Or in some cases, they could charge a lot more than $1.20. They could charge $1.50, which is still below market for comparatively to the other centralized providers.
And some of their miners host AI models, right?
They do, yeah. A lot of the miners are running inference on Targon. So they're hosting things like DeepSeek or Quen or Llama or these other open weights models. And some people are training AI models from scratch on Targon compute. I mean, it's basically a compute provider, so you can do anything. You could use the GPUs to run game servers. You could do anything with the GPU compute.
Does Targon give more rewards for miners who provide not just compute, but also compute plus AI models and inference?
Not yet. I think right now it's just focused on the AI compute, but over time, I think they're pricing things based on the availability of model hosting and inference endpoints. And they've been adding premium hosting for lots of different endpoints pretty recently. So actually, I think, yes, that is the case. They host cost competitive pricing of all the latest open weights models, whether it's Kimi or DeepSeek or these other state-of-the-art open models that are getting produced, which is happening at a rate that's mind-boggling. A year ago, many of these models didn't exist, right? When we were here in Toronto last year, or when I was here speaking at the same Google office, DeepSeek didn't exist.
It did?
It's pretty mind-blowing how much has happened since then.
Wow.
I mean, and I think DeepSeek did exist, but it was completely off the radar. And the DeepSeek R1, which was like the big moment that DeepSeek released chain of thought reasoning and these kind of reasoning models, which then OpenAI actually caught up to and copied like a couple weeks later. A lot of people don't realize the DeepSeek team innovated substantially when that release came out. I think it was January 20th. January 20th was a huge moment for the world because we started to see this hedge fund in China actually outcompete Western labs with a fraction of the cost. And if you recall,
right. Nvidia collapsed.
January 20th was a day when there was a massive correction in public markets overall, actually. And it was called the DeepSeek moment. And the Western press was really freaked out. I think it was about $1 trillion of market cap wiped out in a day.
So how good, like the best latest DeepSeek version right now, how good is that compared to like the latest version of ChatGPT?
I think that they're not far apart. It depends on which benchmarks you use and depends on how you measure things. A lot of the things that I read about are from people that say there's this kind of like vibe or feeling that the quality bar or the sort of like accuracy and familiarity the model might have with certain kind of data sets or concepts is more, it feels better trained and more accurate than something like DeepSeek. But if you look at DeepSeek on a lot of specific benchmarks, I think it actually outperforms in certain areas. So it's not a uniform comparison. You can't just say it's like better or worse on all dimensions. I think it depends on how you measure it, in which ways you're measuring it. This is also true for a lot of models that are deeply tuned on specific domains. I think it'd be much smaller models, but they would actually outperform the larger models on a lot of specific tasks, whether it's like programming in certain languages or vision object detection in certain areas or translation. So there's a company called Liquid AI. I'm an investor, and they have Japanese translation models. These models are state of the art, most performant at translating Japanese in a very small, compact parameter count, like a couple 100 million parameter model. If you compare that to the latest, biggest state-of-the-art models of Japanese translation, vastly outperforms because they've fine-tuned and given that model lots of specialized fine-tuning and pre-training.
So it's so interesting to me. So if I'm a startup, I don't have Nvidia GPUs, I don't have my own AI model, but I need to do some basic inference. Like I need to have, here I'm a dentist's office, here's my customer service window. I need to train a chatbot that then I have a widget on my website that talks to customers.
Yep.
I could basically do that and pay by the inference, maybe, I don't know, through Targon, which is hosting the NVIDIA GPUs, hosting the AI models, doing the inference for me, and taking my data set so I could fine tune the results to cater to my customers.
Yep.
And coming up with the fine tuned AI results. And then and spitting that on my window for super cheap. I spend the least amount of money using Targon versus, let's say, OpenAI. Targon, they're like Uber. They're just an intermediary between NVIDIA GPUs that are spread out all over the world. Targon probably doesn't even know where their GPUs are. And the GPUs are hosting AI models, open source AI models spread out, again, all over the world. And again, Targon's probably raised nothing, spends almost nothing. And what they get is they get these rewards in the form of these Bittensor alpha tokens. Some are given to the miners, the people who are giving the compute.
Yep.
Some are given to the owners of Targon, so they make money. And then the customers benefit by paying the lowest price. And owners of Tao benefit by funding, basically by enabling this whole ecosystem. Investors are providing the ecosystem or environment where this entrepreneurship can happen. And so investors in Tao, the parent token of all these other tokens, get to benefit.
Yep.
And right now there's 128 of these companies essentially on Bittensor. They're called subnets.
Correct. Yeah, Bittensor subnets are a super fascinating. We've been talking about this now for a couple months on the podcast, or I guess like a month and a half.
It feels like a couple of years already.
Yeah, it feels like a couple of years. But this is our 7th episode.
Yeah.
And I think what we talked about last week was just like comparing subnets to equity or alpha tokens to equity. And we just had a long breakfast. We were talking a lot about this. So this
heated,
very fresh and heated on our minds. But the way I think about alpha tokens with respect to startup equity, there's a lot of big differences, but there's some similarities because in the very early stages of the formation of equity, it's highly speculative, right? Like when you're creating a company and it's a seed stage idea, there's lots of innovation, there's lots of smart people that come together to create something useful and to solve a problem and to do that in a different, more differentiated, more innovative way. It's the whole point of startups, is to create a better solution to solve a market problem, to solve a pain point in a more efficient way, in a more innovative way. The nature of that requires a lot of conviction and belief and faith that this team will eventually build a really valuable product and monetize the product and deliver long-term profitable results, right? Revenue that is profitable, is positive margin. But all those things I just mentioned, this trust, belief, this conviction, all those things are synonymous with speculation, right? We're really speculating on the potential, the future potential of the team. I'm a seed investor. I've been a very early stage seed venture capitalist for 7 years now. And I've invested in dozens of companies from when they were zero to getting to millions of dollars in revenue, and done that a bunch of times. And what I've noticed is like the degree to which you have to speculate on the potential of people, their raw potential, is very high. And so you're often just really pricing things at a level that frankly is actually really close to where pretty much all the subnets are today. Like the average, I think, circulating market cap of actually vast majority of the subnets on Bittensor, in fact, even most of the ones in the top 10, is in line. It's very close to be in line with the average pricing of seed, pre-seed valuations in venture capital. So I would call it a range of $10 to $50 million. That's how you would price a company initially. And that's actually also in line with the sort of the check sizes and the investments that VCs write at that stage, at like $1 to $5 million kind of thing, or 1 to 10. A lot of seed rounds these days of these AI companies, so the seed round is $500 million.
Yeah, it's crazy.
$100 million. Those really aren't seed rounds. Those are very significant amounts of capital that are in service of acquiring compute. And you're not doing that to pay your founding employee $5 million salary. And I think some people actually are doing that, which I believe is totally insane, right? Like the human knowledge commoditizes very rapidly. And the skills that people who are training AI models and inference pipelines and so on, those skills that they have, that they possess, are going to be very rapidly commoditized across the whole industry. So I think what's more important is you speculate, but you speculate up to a certain point, which is you give people a certain level of value in faith, in good faith, essentially, right? So let's say up to something in the order of tens of millions of dollars, when they really have nothing more than a paper napkin, right? Like some blank sheet of paper. And that's very common and normal in venture capital at the very earliest stages. Where I think things start to get a little perverse and disjointed from reality is when you see a company that has no revenue and they have no product and they have no users, but they start getting valued at hundreds of millions or billions of dollars. And when they haven't actually delivered an innovative technology. And so I think one of the things we should talk about a lot, which is I think what we plan to really dig into, is like the speculative nature of alpha tokens on Bittensor is high.
Yeah.
But the pricing of even all of the top subnets, several of which I'm sure we can talk about, have produced incredibly impressive results, very capital efficiently, are actually very much in line with really the lowest valuations that you would see in venture capital. So 10, 20, 30, 40, $50 million valuations. Even Shoots, which is like 4 or 5 trillion tokens per month, hundreds of thousands of users. They probably reached many millions of people through the models that are hosted on Shoots. Their valuation is $60 million on Bittensor.
Yeah.
So it's kind of impressive how innovative these subnets are. At the same time, there's a lot of speculation.
Yeah, but you make such a great point with equity. And I want to, again, when we talked about this a little last week, but I want to again get to this, like, what is the linkage between what an equity valuation is, how we normally think of it, and what the alpha valuation is of a subnet? And you're right, when I invest in a startup, I have to trust so many things. I have to trust, is the product a good product? Or can the founder even execute? Can he make the product? Can he do marketing? Can he sell the product?
Yeah.
And also I have to trust that they're going to manage the money I give them efficiently so they don't have to dilute me with further equity raises.
Correct.
I have to trust that they're also going to be honest. They're not going to just issue a ton of equity to themselves without telling me. But at the end of the day, I'm doing it because the founder has told me a story rooted in reality. Let's say I invest in an Alzheimer's drug.
Yeah.
That Alzheimer's drug, they haven't even made it yet. Then they're going to have to put it through FDA trials. It's going to be billions of dollars and years before they sell it to a market. But the market's $100 billion in size. So I know that they're going to get some percentage of $100 billion. And some percentage of that is going to go straight to me, depending on what percentage I own of the company. And so I know at the end, if I believe everything along the way, I'm going to make billions of dollars on my tiny investment, hopefully. Most of the time it doesn't happen, but that's why I speculate.
Correct.
And that's what the trust is, along the bridge of trust to get to real value creation. With the alpha tokens, there's one additional thing I have to trust, which is that the subnet owner is going to link that eventual value creation back to the amount of alpha I own. So the more alpha I own, the more I benefit from the success of the company.
Yes.
And right now, I just have to trust that the subnet owner is going to do that. As opposed to equity, there's no real legal mechanism for that to happen. The subnet owners don't have to care at all about their alpha owners. Now, what we discussed last week is that if they don't care, then the miners will just leave.
Yes.
The miners haven't done that yet because the miners are still they're trusting that the subnet owner is going to be good and he's going to eventually take care of the alpha owners. So there's an extra trust factor that they put in.
Yes. It's interesting. The trade-off between acquiring the incentive, the reward, this is compensation, capital, alpha, the risk factor for a miner is almost less than it would be for a speculator, for a Tau staker, for someone buying the alpha with Tau, because miners are producing oftentimes very a difficult, competitive process, some useful, productive commodities and work, some proof of work, but they're rewarded right away in the alpha for doing that. And so if their cost basis for producing that work, in some cases, some of the subnets require a fairly expensive commodity like a GPU compute, for example, but many of the subnets don't require any physical cost of capital. You're just producing some data set or some algorithm or some prediction or some kind of basically zero marginal cost technology of some kind or data of some kind. And the miners very often will just sell the alpha that they get rewarded for in service of mining the subnet. And they have,
Because they have to pay for the resources.
or they don't have long-term confidence in the subnet and they're just going to sell down the alpha. In some sense, that represents the lowest risk way of acquiring alpha. What also happens, though, is you have people that speculate on the price appreciation of the alpha through staking and buying the alpha with their Tau. And they are putting up risk, right? Because they have pre-existing Tau that they bought. And now they're staking it into that subnet. The subnet does well, their Tau multiplies more. If the subnet does not do well and the alpha reduces in value, they lose Tau.
But what does it mean the subnet do well? Because that doesn't always mean, and this is always the concern, which is the subnet owners really have to make sure that when they do well, it means that the alpha token holders do well. That's why someone would buy an alpha token.
Yes.
So what subnets, who do you think is, and I know this is all beginning, but what subnets do you think are getting close to equating their value creation, their success with the success of the alpha token holder? So people should, so I can go out and say, oh, you should own the alpha tokens for this subnet because eventually you'll see huge value creation.
Yeah, I think that we're starting to see pretty early signs of subnets monetizing the commodities that are being produced. So, for example, on Targon, they're monetizing the compute that miners provide. And the representation of that monetization is getting rewarded back to the alpha holders because Manifold Labs, which runs Subnet 4, basically takes the revenue margin that they make and they buy back the alpha. They buy back and they burn what they bought back, and so they reduce some of the circulating supply.
And have they seen the price go up because of that?
Absolutely, yeah. They basically use their owner burn wallet to buy back the alpha, and that increases the value of the alpha. At a certain point, though, they'll need to show that the miners also express that same symmetrical long-term conviction, because right now there's a lot of miner sell pressure on Targon as well as many other subnets. In fact, sell pressure has been a really big problem. So I think if we really zoom in and are a lot more precise about the problem on Bittensor in terms of linking, as you say, the value capture of the commodity back to the alpha, is probably the more fundamental sign of connecting that value is that the miners don't sell.
Well, and I think that can happen
because the miners are going to have longer term confidence that the alpha is going to be the store of value for the success of the subnets being monetized or being marketed or being continuously improved, and however the subnet continues to become more successful.
So let's say I was a miner on Targon and I see that their revenues are going up, and I can see that because their demand for my resources are going up as a miner. And I also know that they're taking their revenues and they're buying back the tokens, which is putting buying pressure and upward price movement on the token. But now if I'm an investor, I'll see that also. And I'll say, their revenues went from 50,000 a day to 100,000 a day. And I saw the price double. And I think the revenues are going to keep doubling. So the price is going to keep doubling. So I'm going to buy and hold forever their alpha because of this. And so then the miners will say, oh, if these investors are doing it, I'll do it. And then it creates less sell pressure. And then if Targon is consistently buying back their tokens, then with their revenues, and their revenues are consistently going up, now suddenly there's a reason for everybody to hold onto the alpha. The only way that this equation would fall apart is if people are afraid Targon is going to sell their company to, let's say, a Google, and then the alpha owners don't benefit at all from that. That would put a little bit of selling pressure if there's rumors that that Targon's going to sell the company. So they would have to avoid that problem.
Yeah, they would need to avoid that somehow by decoupling Manifold's control over the success of the Targon commodity from Targon. So they would need to create some type of structure that has like an ecosystem foundation. This is what a lot of crypto companies do, by the way. They have a separate entity that's a foundation, like essentially a
I always
nonprofit
wondered why they
foundation.
would do that.
They do that to decouple the relationship between the company and the cryptocurrency for all kinds of tax and compliance and SEC regulatory reasons. Principally, mostly because of the uncertainty around the regulatory policies from the SEC, especially in the prior administration, which was very antagonistic and combative almost with the crypto industry. And now under the Trump administration, things are much more friendly and there's a lot more clarification.
Yeah, no three-letter agencies exist anymore. Just like who knows how long it will last, but all the three-letter agencies have essentially shut down when it comes to crypto.
Yeah, it's pretty surprising, but I think we're also getting more clarity on the SEC's policies and regulations towards crypto. And so this is making the life of these crypto companies a lot easier in terms of just understanding where they can actually invest in and structure their companies and how they can actually do that. But I think it's still a really interesting and open question how long-term value is preserved or captured in these alpha tokens. And I think if we look at the world of equity, it's really illustrative or instructive, right? Because you have to think of the constraints of equity. Constraints of equity are just fundamentally different to the constraints of these alpha tokens because you can continue printing more shares in the world of equity. In fact, most companies do this.
Yeah.
Most companies in the private markets do this very aggressively through what's called equity capital financings. So seed happens and then the Series A happens and you issue more shares to raise the Series A money, it dilutes the shareholders. Maybe the Series B happens and you issue more shares, dilutes the shareholders again, right? So if you bought 10% of a company at the seed stage and you thought you did really well because the company sold for $10 billion and you made $1 billion, did you make $1 billion? Actually, at the end of the day, maybe you only made $100 million because the company diluted your initial share by 90% because they printed that much more share count in basically subsequent equity financings. This is extremely common, actually. Same thing is true with public companies. They issue more shares to acquire more of some resource or some investable asset or invest more in the business somehow, but that's a dilutive process. And so one thing that I was reflecting on this last week is there's actually one company in the history of businesses in capitalism that's a very well-known public company that has almost taken the exact opposite position in terms of share manipulation or share issuance, which is Berkshire Hathaway.
Yeah.
Berkshire Hathaway has been extremely averse. Charlie Munger passed away recently, but it was really Charlie and Warren who were very clear and very aggressive about this over many decades. And Warren continues to be, which is that when you dilute the cap table and you add more shares, it causes an enormous erosion of value for the business long term because you decrease the trust in the management team, preserving the share sort of issuance. And you also reduce the ability to precisely calculate how value would be captured by that company, right? Because if you have a certain number of shares, but then you print that number times two, whatever calculation you came up for the valuation methodology of the company is now cut in half. And so that's a huge uncertainty, right? Because the share issuance is in control, fully controlled by the board of directors of the people who run the company. And so what Berkshire Hathaway has done instead is basically invest in long-term, highly profitable cash producing businesses. And they take that cash and they either buy back their share or they distribute the cash back to the shareholders as a dividend, which is extremely welcome by the shareholders.
Yeah.
As people just continue getting dividends. And many people just get dividends and they just live off of the dividends.
So I was just reading, Berkshire Hathaway has never had a secondary offering. They've never just issued more shares, diluted all the current investors just to raise more cash. And the only time they've ever issued shares to buy another company was they bought so much Coca-Cola, they did do it in a little bit in exchange for shares. And then when they bought Genre in 1997, which was the biggest insurance company in the world at the time, they issued shares. That's the only two times. And then other than that, it's like Bitcoin. They're like, I have a fixed supply of Berkshire Hathaway shares, which is why their stock, like Warren Buffett first bought their stock at, I think, $7 in 1966, around there. And today, Berkshire Hathaway shares are like $750,000. It's like unbelievable. So it's moved in a weird way, like Bitcoin. Hardly issued any new shares ever. And by the way, it reminds me of Bittensor because each company within the Berkshire Hathaway family, they're not really connected to each other. There's like See's Candy sells chocolates. Fruit of the Loom sells underwear. Oh, here's a big investment in Coca-Cola, sells soda. Here's the Washington, or it used to be the Washington Post. Now it's owned by Jeff Bezos. But they have all these dozens of companies that are almost like little subnets.
Yeah.
That benefit from the infrastructure of Berkshire Hathaway. If these companies could have down years and up years, but the fact that Berkshire Hathaway rewards them based on how they do, but also protects them on the down moments as well. So it reminds me a little bit of Bittensor and
Yeah.
the subnets. It's very interesting how, and you can think of Warren Buffett as a pure capitalist. Like he's not trying to use the system to reward himself more. He's fair and he's one of the richest people in the world and has done extremely well by all the shareholders.
Yeah. And I think it goes back to the principle of treating shares as a scarce and finite resource.
Yeah.
A valuable, scarce, finite resource. And if you look at Bitcoin, which is the motivator for the design of Bittensor, and Bittensor shares the same supply constraint characteristics, like it's a pretty profound feature when you run a business and you treat share count as a finite, scarce, extremely valuable resource. When you disrespect that resource and you inflate it away by issuing more and more shares every time you do a financing, which is the most common popular way to build technology companies, right? Is a seed round, Series A, Series B, Series D. And I'll say, somewhat embarrassingly, a lot of my companies do that we invest in, that we helped form from the very beginning, from either scratch pad stage or from their first financing event and that they've ever taken. And I often tell all of our companies that they should never raise capital ever again after they raise money from us. Because if they use that capital as efficiently as they possibly can, they're never going to need to dilute themselves and sell more of the company. And it will also force them to create constraints and discipline around producing the most efficient, profitable product they could possibly create. Because in many senses, equity financing is the most expensive, dangerous way to actually raise capital. A much more effective way to raise capital, which isn't a form of raising capital, but it's generating the same result of cash and liquidity on the balance sheet, is to acquire capital from your customers, build a really valuable product, get the customer to pay for the product, and you retain the customer by delivering more value than you capture. And that's in many ways called bootstrapping a business or doing it without venture funding or without capital. But actually, a lot of the largest technology companies in history did this. They raised very little to zero venture capital. They spent a small, moderate portion of what they did raise, and they ended up creating very profitable companies. So I think it goes back to a bigger question, which is what we were talking about a lot of. It's just like, how are companies valued? Principally, in a large scale, they're valued on cash flows. But at an earlier scale, they're often valued on the revenue and the growth rate of the revenue and the multiple of that revenue.
I think because those are milestones on the way to cash flows. I don't know what Amazon's when in 2001, nobody would have known what Amazon's cash flows would have been. They lost an enormous amount of money. So you look at the size of the market, you look at their revenues, you look at the growth in their revenue, you say, oh, this company is going to make a lot of money in the future. And so shareholders weren't dependent on getting paid immediately, but they knew, hey, if I hold these shares for the future, there's enormous cash flows waiting for me.
Yes. And I think we're now at a stage in the Bittensor network where these questions are really important to ask. And we need the subnet owners and the teams running these subnets to really start to come up with very concrete solutions to these questions. Right now, we don't really have the correct linkages, like you said, in terms of the value capture of the subnet's outputs getting reflected back in the alpha tokens. There's a couple mechanisms for this, like the buyback and burn approach, where you buy back the alpha based on the revenue and then you burn. But that again trusts the teams to do that. But it also implicitly says, in the absence of a better use of that capital, you're just buying back the alpha, when maybe they should really take that money and invest in further innovation, further growth, product development.
It's true. Like, for instance, Berkshire Hathaway didn't buy back for the first 30 years. They didn't actually start buying back shares until 2011. So 45 years it took them before they started buying back shares, because 1966 to 2011. So trust is a really important thing. And I'll give you an example from Berkshire Hathaway again. So in 2004, I went to their annual meeting. I was writing a book about Warren Buffett at the time. It's called Trade Like Warren Buffett. And I was talking to this guy who told me, he's a real old guy. And he's like, yeah, in the 1970s, I was living in Omaha. I heard about this kid running this company. I bought 200 shares. And a year later, the shares had doubled. So I didn't know what was going to happen. So I sold 100 of them. I sold half my position. I sold 100 shares, and I started a restaurant with the money. Restaurant did really well. The other 100 shares are now worth $76 million. So he could have just, but the problem was, and he didn't trust Warren Buffett enough to hold his whole position. The other half could have obviously been, now I'm sure he had other benefits from owning a restaurant. It was fun for him. It gave him his life meaning.
Yeah.
But he could have had another $76 million, and it had nothing to do with economics. Trust was the entire factor by which he felt like he needed to manage risk because he can't trust completely. So he sold half his position, took some profits off the table, and Bittensor is so early in this equation, it's even harder to trust the system, and it's harder to trust the subnet owners.
Yes.
So the subnet owners have to be more explicit about how they're going to give value to these alpha owners. Because look, this is what Wall Street asks. They ask, why aren't these alpha tokens like meme coins? Like Dogecoin, there is no use case for Dogecoin other than the fact that it's this joke that Elon has tweeted a lot, so people think it has value.
Yep.
But meme coins, there's something like 20 million meme coins out there. 0 of them have value.
Yeah.
And Dogecoin has a little value because people think it's funnier than the rest for some reason. As opposed to, let's say, I'll give an example, like Aave, AAVE is a lending protocol. It helps people borrow money against their Bitcoin, and they share the revenues from their lending with the people who hold the Aave token.
Yeah.
That has a use case. I'm going to benefit as Aave grows. If I own Aave, I will grow. My cash will grow. And that's built into the code, so it has to happen. So there's the trustless factor of crypto there. It's the alpha tokens need that a little bit. How much of that could be built into code, or how much do we have to sort of trust the owner of the subnet?
I think subnet teams need to create mechanisms that reduce the trust and create more trustlessness around the alpha tokens being really the store of value for the commodity. And people think of Bitcoin now as a replacement for gold. I was watching an interview with Larry Fink the other day, and Larry's very bearish on the massively inflationary situation in America. Like, we've printed something like close to $30 trillion of money in the last few decades, which is mostly the last 5 or 6 years.
Well, in the year 2021, 40% of all the money printed in history was printed like that year.
Yeah, pretty crazy. So I think that the trust in assets is a function of the discipline in which the asset represents and preserves the value that it's connected to. And so in the world of currencies, people use currencies to basically trade goods and services, to transfer money, to get compensated, to basically exist in society. Gold is a less interchangeable medium, but you can still certainly use it as a medium of exchange, but it's more of a longer term store of value where you like store your wealth, like long-term storage versus short-term storage in computers. You have like layer 1 cache, layer 2 cache, and then RAM, and then disk, and the long-term like tapes and whatever block object storage services. That's like how I would think about the difference between mediums of exchange and stores of value. Mediums of exchange, like short-term memory, like fresh, instant, like you need to have that like fast retrieval. And long-term storage is really something like Bitcoin, where you have cryptographic guarantees of digital scarcity. It's never been hacked. It's now storing trillions of dollars in value. And it's actually within an order of magnitude of the success of gold, at least the mined gold on the planet, which is, I guess, $25-30 trillion. So Bitcoin is like 2.5 trillion, so it's like 10x away from that. And I think what Larry Fink was saying was, if the United States continues its reckless monetary policy that is completely unsustainable, the only solution to that is growth. And that was really the silver lining in his comments. It's a very recent podcast from last week. It's pretty easy to find. What he mentioned was the only way through this is growth. And I think he said the United States needs to grow at 3% per year for the next decade in order to actually solve these problems. And we're growing at much less than 3% per year currently. And certainly maintaining that for a whole decade represents a really significant challenge. That would be very difficult.
And he's saying the same thing that basically Satoshi, the creator of Bitcoin, implied with the creation of Bitcoin. So part of the reason for Bitcoin was to protect against human error. So human error could mean when you're making a bank transfer, the money gets lost because the human typed in the wrong account number.
Yep.
Or human error could mean Jerome Powell, the head of the Federal Reserve, prints up an extra $1 trillion, mistakenly thinking we were having not enough inflation or too much inflation or whatever. And so that's a big human error where the value of the dollars in your pocket are going to go down, and it wasn't your choice. And so she said, algorithmically make it so nobody can do that. There can't be printing of more money. It's algorithmically prevented. It's trusted. So you don't even have to trust anybody.
Yep.
Right now, you and I and everybody listening has to trust Jerome Powell. Please don't print too much money. Please be kind to the dollars in our pocket. And so what's interesting with Bittensor is that I feel, as you mentioned, Bittensor has all the qualities of Bitcoin. The incentive mechanism's different, but in a good way. And look, your subnet, TaoHash, you mine Bitcoin in TaoHash. You could literally recreate Bitcoin in a subnet of Bittensor, you personally. But Bitcoin, as we mentioned last week, Bitcoin cannot recreate Bittensor. So a lot of it is the story we tell. Like Bittensor should be, in my opinion, more valuable than Bitcoin. Like one subnet could recreate all the value and functionality of Bitcoin. And by the way, then you have all of the companies in capitalism as well, or what we've been calling incentivism, can be recreated on top of Bittensor. So we were talking about this at breakfast. You mentioned there's $150 trillion of fiat currency in the world. And of course, Bitcoin should represent more and more of a greater percentage of that. But there's maybe $500 trillion of corporate assets in the world. And Bittensor should represent that plus some percentage of that plus the fiat currencies in the world. And I think that is what's going to start to happen as this story gets told. This is Bitcoin at 2013, but bigger.
Yeah, I don't disagree. I think that there's a huge amount of technical barriers on the way to realizing that. And something I blogged about a few days ago, or about a week ago now, is in the early days of scientific measurements for the speed of light, our error margins, right? The lossiness of actually precisely measuring the speed of light was extremely significant. It was like 90% off, right? It was 10% accurate, right? But this is a really significant margin of error. And it took another 100 years. I think this was like in the 1500s or 1600s or something, like measuring the speed of light. And
how would they even do it then?
I need to actually refer back to, I think they had like very rough mirrors across big mountaintops, and they would basically cover their hands and make some estimation in terms of the delays of the millisecond level delays that they could perceive. But the instruments were not, and this would be like 30, 40, 50, 100-mile distances of mountaintops, like late at night, that they could actually like create a match and some spark of light and then basically go and make some rough calculation. And the person would be on the other side, it'd be like, oh, it was like small, imperceptible time differentials, but it was very rough.
Yeah.
We created more and more accurate, more precise measurement instruments over the centuries. And we gradually reduced the error margin from 90% inaccurate to 50% inaccurate to 20% to 5%. And we eventually got to around 1% accuracy only about 100 years ago. And about 50, 60 years ago, we were able to actually get to almost perfect precision within many decimal places of accuracy to say speed of light is 299. And Einstein had a theory for this, right? He actually postulated that the speed of light was some kilometers per second, like almost 300 million kilometers per second. I think it's just under 300 million, like 299 million kilometers per second or so is the speed of light. And that was scientifically proven like a few decades later when we had the instruments to be able to prove it. He was correct. And so I think of Bittensor incentive mechanisms is a similar thing. Like by analogy, the initial measurement devices for measuring value for different types of digital commodities, they're actually quite rough. We're using, like in the context of bridges, we're using these benchmarks for what is a state-of-the-art coding model. State-of-the-art is only state-of-the-art in terms of how you're referencing and measuring state-of-the-art. It's not perfect in terms of where things will eventually be in 5 years or 10 years, where we're going to be looking at the current, like absolute most incredible state-of-the-art models today as super primitive, like caveman drawings in 5 or 10 years, just based on the rate of technology improvement. It's very difficult for humans to conceptualize how fast technology is improving. It's improving at a hyper exponential rate. And there's this discontinuity in terms of the progress of technology relative to the progress of human intelligence and human biology, right? I think 20, 30 years ago, we've probably completely disconnected from the speed of technology improvement as a species, right? Like our biological evolution has failed to keep even remotely close to the pace of technology evolution. But my point of Bittensor subnets and measuring things like the speed of light, or this is like a pretty fundamental constant, like in science, it's like the speed of light regulates our notion of reality and like all the principles of physics that we're aware of. These Bittensor subnets, the role and the sort of the challenge, the task of these Bittensor subnet owners is to basically create better and better measurement devices for measuring and representing value. But the bigger question that we're talking about is how do you actually then translate the value that you do create by virtue of creating these measurement devices into something that represents the durable value capture in the alpha token, which is how you actually incentivize the production of the commodity that the subnet miners are producing. And that's the piece that I think is really tricky. And it's similar to the same era of Thomas Edison and Tesla and Einstein and these geniuses. Some of them captured value, many of them did not. Tesla was very famously poor and died impoverished and of probably diseases and sickness that he could have solved for if had he had some moderate wealth. Whereas Thomas Edison was a capitalist and he created all these patents and was able to go and monetize very effectively, and he was a very aggressive business person and he had a very wealthy life and was able to capture some of that value. And of course, in the context of Einstein's ironic, started off as a very heavy patent business oriented clerk evaluating designs and reading patents in the patent office, and like a boring job, and eventually realized like that's not how he wanted to spend his life and wanted to become a scientist and pursue theoretical physics. So I just think that this is almost a universal problem. It's like a lot of the smartest, most brilliant people in history, they die poor, they don't capture any value, but they create enormous amounts of value, right? And I think what Elon did with Tesla is a great homage and paying respect to Nikola Tesla, who died poor. But obviously Tesla, they have this incredible roadmap. They have these great products. There's some speculation built into the stock price of Tesla. But at the same time, Elon's really created an incredibly valuable business, right? And he was posting about this a few days ago. Tesla raised a few $100 million, which today seems really tiny in terms of how all these AI companies are raising tens of billions of financings, Anthropic and OpenAI in particular. But Tesla went from being founded in the early 2000s, 2002, I believe, 2002, 2003, to going public in 2010. And in 2010, well, actually, no, I believe it was 2009.
I forget.
I think it was May or June 2009 when they went public. And then 16 years later, after having gone public, they generated 100 billion of cash in gross
That's
market
unbelievable.
cash, which is really truly incredible. If you look at their market cap, it's only 10x, not 10x the revenue. They've probably generated maybe $500 billion in revenue. But in terms of the cash that they've generated as a business, it will be roughly a 10x of the cash that they've produced. And obviously, there's some speculation on the Tesla stock in terms of Optimus and the humanoid robots and all the other product lines and things that Tesla, Uber Cab, and all these other products that Elon has cooking over there. But I think all equity value is some combination of speculation for the future, the value that the company can capture over time, but also cash flows and the profitability of the business. And this is the thing that I think alpha tokens will really have to figure out. You have to build really valuable products and connect the value of the successful product back to the alpha token in a durable way, so that your miners reduce the sell pressure, so they believe the alpha will preserve long-term value, so that the speculators and people staking and buying the alpha will also believe that the alpha will have long-term value, so they don't sell down. So they treat it more as a long-term value investing instrument versus a meme stock or a speculative cryptocurrency.
It's so interesting because actually what you were just saying totally has blown my mind again. So equity, let's say a company buys another company. They either buy the other company with cash or they buy it with equity. So they can almost use the equity as money, but they can't go to the store and buy a cup of coffee with their equity. I can't go to a store and say, oh, I'm the CEO of a company.
Correct.
My company is XYZ. You could have some equity in my company for a cup of coffee. So they can't really use their equity. It's like a currency, but it isn't.
Yes.
And alpha tokens, the tokens of the subnets on Bittensor it's almost the reverse, because they're cryptocurrencies. So it has the word currency in what they are, made up for each subnet. But really they're a way for subnet owners to pay for their resources. Targon pays for computing power using the alpha, and then but it's an easy way to pay with what will ultimately become something like equity. So they're going to create the value they ultimately create at Targon or any subnet. I'm just using Targon as an example. The value they create in this subnet will ultimately, they'll figure out, if they're smart, they'll figure out how to translate that value into their alpha tokens. And then people will be willing to accept their alpha tokens essentially as a cash reward,
Yes,
because there's some value in it. And the problem with equity is that there's so much regulation. I can't use my equity to pay for a cup of coffee. That would be illegal. The convenience store owner selling me the coffee would have to be an accredited investor, and I have to do KYC laws and know your customer and anti-money laundering laws and all these other things in order to pay. But alpha has none of these problems. It's alpha tokens. It's made up. And so people who criticize Bittensor say, oh, these alpha tokens, there's no real value there. You just made it up. But that's the same thing true with equity. Equity is made up until there's actual value creation.
yes.
Alpha is the same thing, combined with the fact that not only does there have to be future alpha creation, but the subnet owners do have a responsibility.
Correct.
They have to create an eventual use case for the alpha. Oh, this alpha is going to be paid with future profits.
Yes.
Not necessarily profits today. I can tell you, I can say, look, I'm going to have $1 billion in profits later. So you might as well hold the alpha when it's cheap right now.
Yes.
So alpha comes at ownership or ownership of value, the opposite direction from equity. And that's the thing I haven't quite realized until now. They're the same thing. They're just coming at it from different directions.
Interesting. So it start off as a currency, in
Yeah.
a more liquid currency kind of way.
A currency which you have to convince people has value.
Right.
Like fiat currency, we convince people it has value because the US government has an army and guns, and if you don't pay your taxes, we'll shoot you or shut down your bank account or whatever.
Or put you in jail.
Yeah. And so then that convinces people that, hey, they got the army backing up the value of their currency. It's all good. And by the way, if you don't even believe in that, there's "In God We Trust" on the back of a dollar bill. Hopefully you believe in God. And with alpha, it's in the subnet owner. We trust that the subnet owner is going to eventually, and we've got to see examples of this, but it's eventually going to transmit the value they create in their products back to the alpha owner. Whereas equity, it's baked into the legal that if the owner of the company makes billions of dollars, then they have to share that success with their equity holders because you own a piece of that success. You directly, legally own a piece of that success. It's built into the law. So you have to trust that the owner is not a criminal, and you have to trust that the law is going to be followed. But you can't use it to reward everybody you run into on the street. You can't reward minors with equity.
Yes.
You can't do all this other stuff. So it's arriving at the same thing, but just from the exact opposite direction.
Yeah, not to criticize equity too much, but one of the negative aspects of equity is that there's a superset authority that has more kind of power and influence over all equity markets, which is the government.
Yeah.
And to your point, what ultimately, in a lot of sort of philosophical ways, has more power and control over the government, perhaps not in a mechanistic sense, but at least in a belief system sense, is religion. And so, like religion, government, equity, currency.
Yeah.
But ultimately, currency connects back to government because government creates the currency and prints the currency. And then capitalism exists, or companies and equity exists, because the government creates the thing that allows the equity to actually have long-term representation value through cash flows, because cash is fiat.
Yeah.
And so it does beg the question, if the purpose of all companies is to maximize the long-term DCF, discounted cash flow, then do we actually have the sort of the fundamental conviction in the long-term purchasing power of the fiat currency? And the current state of things, the largest money managers in the world do not believe that to be the case.
That's why BlackRock, is the largest money manager in the world, is going headfirst into Bitcoin.
Yeah.
That's why, by the way, that's why the president of the United States is going into Bitcoin. People, okay, you can be very cynical, and I'm not political, also not getting any politics into this. Donald Trump and his family had a problem getting bank accounts in the last 4 years when he was not president. So he realized, what if we are in a world where if he looked around, like, oh, a lot of people can't get bank accounts. If the bank doesn't like you, they will not give you a bank account. And he and his family experienced that. I'm not defending him in any way. It's not about politics. This is why he became aware of Bitcoin. He wasn't really aware of Bitcoin in his first administration. He became aware of it when banks refused to give his businesses accounts.
Yes.
And so he says, oh, I have to keep my money in something else that's not a U.S. currency.
Yep.
Well, I don't trust an Iranian currency or the British pound, because they might do the same thing, or the Chinese renminbi, they're going to do the same thing. Bitcoin was trustless. So that's what got him and his family into crypto. He saw that was an amazing use case, is that he didn't have to trust the government.
Yes.
And that turns out to be very powerful. I was talking to one of my podcasts was talking to the owner of a very successful pawn shop, and he was telling me up to 20 or 30% of Americans do not have bank accounts.
Wow.
If you have a credit score that's a little too low, you can't get a bank account.
Wow.
And so they have to use pawn shops and payday loans and so on to do banking, which is, I had no idea.
20% of America.
Yeah.
Wow. That's incredible.
Yeah. And so crypto becomes a use case for that. And it's the same thing. If you can't get a bank account, how are you going to start a business? So now entrepreneurs are limited, and crypto again becomes a solution.
Yes.
And again, Bittensor, as far as I know, is the only crypto where you can completely start a business. You have an equity mechanism created for you, which is alpha. Now it's your ability to create value into that alpha. I mean, you're the one who has to create value into that alpha.
Yes.
Bittensor is not going to do that for you the way the government is going to legally require you to share profits with your shareholders and so on. But that is a responsibility that Bittensor will have a lot more value as more and more subnet owners stand up and say, here's how I'm creating value in my equity, but the mechanism's there.
Yeah, I think the thing that I've always been really attracted to with Bittensor is this permissionlessness aspect. Open source succeeds because of permissionlessness. Anyone can participate in the system, discrimination free. This is the whole premise of open source. Richard Stallman called open source originally free software. And the manifesto, we think we've talked about this in the past.
Yes.
Discrimination free review, which is transparency. You can see the code. Discrimination free distribution, running the code, executing it. Discrimination free modification, so you can change it. And also monetization, so you can monetize it with or without changes to the original. And that is really profound because it basically creates maximum kind of distribution and propagation of this technology without any friction, without, you don't need anyone's permission to do those things. Whereas in the world of equity, you need permission from the government to create the business.
Yeah.
You need permission oftentimes from, sometimes if you're raising equity capital, you need permission from the investor on terms. You have to agree on terms. You know, for your employees to hire people, you need their permission to have them join the company. They also,
and they need your permission.
They also need your permission. So it's a two-sided permission system. And all those dimensions with open source, it's permissionless in every possible way. With Bittensor, it almost applies the same permissionless attributes that open source does for source code, but in the context of incentives and value creation. And this is like super, super profound. There's definitely lots of trade-offs in terms of like, how do you preserve and capture that value? Then we need to really start talking about mechanisms that translate and feed the value back into the alpha. But just in terms of innovation, what we're seeing with Ridges achieved state-of-the-art results in coding models on the most universally accepted benchmark, which is the SweetBench 500 question benchmark. And they did not cherry pick different runs, which a lot of the talk labs do. They ran one cryptographically provable run on all 500 questions, and they achieved, I think, 73.6%, which is state-of-the-art for open source.
And what's Cursor, which is the number one, the fastest growing company to achieve $1 billion in revenues, which is their competitor?
I think their competitor runs proprietary models, so they're not open weights models. Ridges is state-of-the-art, 73+%. I don't believe Cursor is more than 76, 77%. So it's like a few percentage points higher. It does get exponentially harder to get that level of accuracy, but from what Shaquille shared with us last night and what we're learning, I think he's very confident they're actually going to get to state-of-the-art even in closed benchmarks, but with open models within probably the next few weeks, which is just incredibly impressive. And again, capital efficiency is here that a lot of people don't understand. The proprietary companies are spending hundreds of millions of dollars building these models that obviously investors are happy to fund because the businesses are generating revenues that go from 0 to $1 billion in a year or two.
Yeah, and how much has Cursor raised?
I think Cursor's raised I believe a couple $1 billion, and they're about a 50-person team. And yeah, I mean, they have, I believe, over $1 billion in revenue. And I think the market cap or valuation VCs have set on businesses something in the tens of billions of dollars.
Yeah. Right? And by comparison, Ridges, which is almost at that level, how much have they raised or how much have they spent?
They've spent in the alpha miner incentive to achieve the results that we described, less than $1 million. And the market cap of Ridges is, I believe it's less than $50 million.
And so here's the interesting thing.
So we're talking about hundreds of times, like orders of magnitude more efficient.
And here's what I find fascinating about Ridges. Because I asked Shaquille this directly, who's the guy who started Ridges, can he survive without the miners? And the answer is absolutely not. And because look, like you mentioned, Cursor's a 50-person team of like the best people in the world. They got the top best 50 and they're able to build the best models. And boom. Now, Ridges has like maybe 100 miners, so more than the number of employees at Cursor. Obviously, they have people because it's permissionless, it's people from all over the world, from every strata of society. And it's clearly the smartest AI model makers on the planet among them. And so almost by definition, because he's neck and neck with Cursor, if he can't do without the miners unless he were to spend billions. So having the Bittensor system is critical for him. And the miners, they could all leave tomorrow and start a subnet unless they're rewarded properly. So he realizes this. He spoke about this on other podcasts. He realizes that he has to connect. He has to make sure for his own success and for the success of Bridges and the success of his miners and for the continued success of everybody, he has to connect the value creation to the alpha token holders, which gives incentive for people to say, I want to invest in that alpha. If you ask me, I would honestly rather invest in the alpha of Ridges than in the equity of Ridges. Because I don't know, like you said, I don't know, okay, I'll invest in equity now, and then there's another equity issuance later, and some of my permissions will get diluted or gone away. And then there's gonna be another round later. But the alpha, I know exactly, it's in the algorithm. I know the math, it's just like Bitcoin, there's gonna be 21 million alpha in total. So if more value is accrued into the alpha, there's no way I could be diluted out of that value.
Correct.
So and I know he's going to solve this, as the founder of Ridges solves this basic thing of connecting value with the alpha tokens. I think on that one solution, that is more than the DeepSeek moment. That says to me, Bittensor's worth $10,000, $20,000. Some percentage of the corporate world, which we just said earlier was $500 trillion. Some percentage has to go into Bittensor, just like some percentage of the $150 trillion of fiat currency in the world has to go into Bitcoin. Because it solves these major problems that exist with equity. The same problems, by the way, that exist with cash, which is potential for fraud, potential for human error, the potential for too many intermediaries, potential for regulations and regulatory capture. And this is all the reasons why Satoshi created Bitcoin. Jake, to his credit, Jake Stevens, who created Bittensor, I don't know if he had all these things in mind, but that's a true visionary of creating Bittensor.
Very much. I think Jake was incredibly inspired by Bitcoin, and he's a Bitcoiner and very heavily influenced by the design of Bitcoin on all these dimensions. And I think it's extremely profound what Bittensor represents. And I think what's really incredible is it's sort of like phase one of proving that Bittensor incentives can produce technology innovation, orders of magnitude more capital efficiently. To me, that's an incredible proof point and provides the case to be made that Bittensor is very undervalued currently. I think it should be multiples more than what it is. I don't know exactly what I would say that a multiple would be. Somewhere between 5 and 10 times undervalued. Well, you just said it's $10,000, $20,000 per token, per tap. It's like this current reserve incentive for all the subnets.
Which would give about $100 billion in value.
That would mean it would need to be priced at 30 times or 40 times more than what it is. And I think in order for that to happen, we need continuous examples of Ridges-like success in many domains, which I think we have early signs of that in a couple of other domains, but we need many examples of this.
Combined with that value link.
And furthermore, the next thing after that is we need to link the value back to the alpha tokens. We need some set of examples. And I would actually just caution people to not over-rotate too much on just copy-pasting the world of equity valuation methodologies, because they're still pretty messy. Like public markets value companies many different ways. In fact, public markets are very speculation driven. And as you said, with the drug discovery example, a lot of companies go through clinical trials and very high risk phases of development for many years. And then if there's a disappointing result, the equity value disappears. And so there was this speculative expectation of potential return priced into the stock. And I don't think pricings are binary things. I think it's a continuous exploratory space. But the way that people talk about value investing, and this is more of like the Berkshire Hathaway school of thought, is you want to invest in businesses that could be run by monkeys, that don't need highly sophisticated management, and that they are staples of the society and the economy, whether it's railroads or Coca-Cola or See's Candies, and they print cash profits because they have capital efficiencies of producing those very differentiated, scarce, highly difficult to reproduce commodities or technologies. And I think for Bittensor, it's sort of the opposite. It's like the Bittensor subnets will produce very abundant, non-scarce commodities that are freely available and open to the world, but the mechanisms and the means of production are the scarce things. The incentive mechanisms, the precision of the incentive mechanisms, the thing that engenders and gravitationally pulls the best miners in the world, the best technical talent, the best engineers, the best builders. If that mechanism alone can be proven to be more effective than any venture capital funded startup, that, in my view, that alone makes Bittensor worth hundreds of billions of dollars. But
I agree.
The way we get to trillions of dollars, which is like Bitcoin level and beyond, and multiples of Bitcoin, is we need a sustainable set of examples and feedback loops that go back into the alpha tokens. But I'm not actually fully convinced that the buy back the alpha and burn what you bought back is the way. I think it can be helpful, but I think we need other mechanisms
I think the buyback and the idea of taking, oh my gosh, I got $1 in revenues, I need to immediately buy back a token. That idea is only working now because people don't trust that the alpha is going to have value later. So they want to see the money going back into the alpha now. But as they begin to trust that, with examples, if Ridges or whoever figures out how to tie future success to the present value of the alpha, then you won't be as anxious. Oh my God, oh my gosh, I hope they give me a piece of chocolate now, or else I'm going to starve to death later. People won't be as anxious if they trust that the value is there. And you could do that algorithmically, or the subnet owners have to figure out how to do that in legal ways or algorithmic ways. I don't know. I do have confidence they will do that, because here's a company like Ridges on the verge of, let's say, multi-billion-dollar success, but this is a stumbling block. They have to figure out how to reward the people that create all their resources. And they know this. It's not like a secret to them. They're not upset about this. This is a fundamental part of building a successful company, and that's what they're doing. But like you say, I think you're right. Continuous examples. This will be the first, maybe, hopefully, and continuous examples have to happen. And then people will say, oh, there's 200, let's say $500 trillion worth of companies out there. Some percentage of that is going to go into an ecosystem like Bittensor. And Bittensor is the only one I could think of that is structured basically to mimic incentivism, or what's usually called capitalism. It creates the incentives for shareholders, for employees, for investors. And the advantage of these alpha tokens is that they can be spent more freely as this hybrid between cash and equity, if it's figured out, like you're saying.
Yeah. One thing that you said around the critical importance of miners makes me think of, again, going back to open source, the value of contributors to open source projects. With open source, it's very easy to fork the code. You can just copy paste the code, fork it, have another repo, and now that's yours. And you can modify it and call it whatever you want and make some modification changes, and that's now your code. But what you cannot fork is the contributors and the community of the open source project that you forked from. The same is true with Bittensor subnets.
Right, that's the value.
If you could fork Bittensor subnets and clone Bittensor subnets, maybe theoretically that would be useful in a vacuum of saying, let's look at the miner history, the metadata, the weights, and we can now fork that state and copy paste it into a new subnet. But what you cannot fork is the miners themselves on that subnet. You cannot fork the community. You cannot fork the loyalty that people have to the team that created that original incentive mechanism. So saying, I'm going to fork Linux. Okay, great. Does that mean Linus and the 1,000 Linux maintainers are going to now start contributing to your copy of Linux? Absolutely not. And so you can fork code. In open source, you can fork code, but you cannot fork community. In Bittensor, maybe you can copy and paste the idea and fork to the subnet, but you cannot fork the miner graph. The miners are loyal to the team that they know is continuously building better measurement devices for the value that subnet is producing. And so again, measurement devices in the context of speed of light, subnets produce measurement devices, which is the incentive mechanism for the value that subnet produces, the commodity that subnet produces. And it's immeasurable value because it's value creation. What we talk about with the alpha token is really the measurement of the value capture.
Yes.
And right now the value capture is sometimes a little flimsy, right? Because you have the sell pressure from the miners, you have sell pressure from speculators, And also the network itself is difficult because it's getting re-ranked constantly based on the emissions coming out of Tau. And there's now going to be a halving. So now all the subnets are going to get only 50% of the emissions that they got before. So that's going to be a very interesting event. Very hard to predict how that's going to play out. It's going to happen in the next couple of months, actually. And so it just really makes me think of like lots of parallels between how the open source ecosystem really works really incredibly well. It powers the entire technology industry. And a lot of people ask the same questions of open source, by the way, like, how is open source sustainable? Why do people contribute to open source? There's no economic model. There's no profit motive. There's no compensation. Like open source is definitely totally screwed. Like it's going to implode. And my friend Jim Zemlin, who runs the Linux Foundation, jokes with me every couple of years. He's like, oh, JJ, there's in the news again. People have predicted the death of open source. The open source is going to be dead. The reality is there's this intrinsic human tendency to want to work with the best people, the smartest people, the most intelligent people. And open source attracts those people for the most innovative and incredible technologies. And this continues to be the case. In the context of Bittensor, what I think is starting to be proven out is if you can create the right economic incentives, which is the entire point of Bittensor subnets, it attracts the highest quality builders who love the nature of open source, but it also attracts just the highest quality developers and people in general who would otherwise go and get a job at one of these venture funded startups in service of maximizing their wealth.
Yeah.
And it's a really fascinating hybrid of both of those worlds. Obviously, we're being very, in this episode, I think more than any of the other episodes, we're more sober and more kind of pointing out where the challenges are in having to solve these things. But really, even if we gradually, incrementally solve these things, that's all we need to demonstrate. We need to demonstrate gradual, incremental solutions to these challenges. And if we can do that, the sky is truly the limit in terms of where Bittensor can go.
Yeah, I think that's true. And I think from this conversation, I see much more of a connection. So let's say companies are just basically vehicles of contained value creation. By contained, meaning anybody who's inside this vehicle will benefit from the value creation. So I'm not using the word equity or token. So equity is the one way to slice up this value creation.
Yep.
But what we're saying is alpha tokens are going to be another way of expressing value creation. It's in a way that is more expendable. So I can pay for my initial resources with this equity. Or equity starts off as imaginary. Like you say, if I fund a startup for $5 million, the CEO of that startup can't just spend $10 of his equity on a cup of coffee. He's got to earn that value. And it's the same thing with these subnet owners. Okay, they have a fully developed, fully diluted value of $10 million, say, but they've got to earn it by creating a successful product, successful customers, and a successful way of linking value creation to the seats on this vehicle, which are the alpha tokens.
Right.
And I think I have faith that will happen. I think I've gone back and forth on that, but I have faith that will happen just from now talking to so many subnet owners and seeing how they realize they need to do this. It's not like they're just saying, oh boy, I hope the miners don't realize there's no value here. Like they realize they need to create this value.
Yes. Yeah. And even with the kind of rampant speculation, which I think is certainly the case, again, if I go back to very early stage equity investing in venture capital, it would not be possible without the speculation because you have to create some imaginary number of shares and a price per share that grants you percentage ownership in the company. And the problem is when that money is wired, and I've done this many times now, it's just a scary process of jumping off the cliff and seeing the money go. And it's like, it's no longer your money. It's now transformed in a representation of this thing called equity that is highly illiquid and has no redeemable value. You can't go and say a startup equity. You can do this with larger stage companies like Stripe or ByteDance or Anduril or Anthropic or these big, massive tech companies that are still private, illiquid shares. The secondary markets are a little bit more active and healthy at that later stage when there's very significant revenue. But at a very early stage, there is this notion of illiquidity. So you don't have any instantaneous or accurate price discovery. It's you talk to VCs every 6 months or every year, you raise another round. It's very kind of guesswork. It's heavy guesswork driven in terms of how the valuations are set. You run a fundraising process, you talk to 20 investors, 2 of them give you an offer, one is higher than the other. You meet somewhere in the middle and you get a deal done. It's so arcane.
Yeah,
and
really is.
And slow. And yet, venture capital is a $2 trillion asset class now. And 15 years ago, it used to be a $100 billion asset class. So it's expanded exponentially in the last 10, 15 years. And something that I continue to maintain is that amount of capital is not necessary. We do not need that amount of money to discover price optimality of the most incredibly disruptive technologies. And even if Bittensor does go to $1 trillion, I continue to believe that like those emissions are just going to be amplifying the effective commodities that transform huge industries. The S&P 500 is not the S&P 500 anymore. It's the S&P 5. There's
Right.
5 companies producing most of the value in the entire technology industry. And this is a very recent phenomenon, but I think it's indicative of like, maybe we don't need thousands of companies in the world to produce most of the valuable goods and services. We probably need thousands of companies to compete and to deliver that, because that's a meritocratic, permissionless system in some sense. It's not actually fully permissionless, as we were talking about registering companies and getting equity capital allocated and all that. But in terms of subnets, we will, I think, eventually need thousands of subnets. Today, we have more than enough subnets to be able to find the space of exploration and discover which commodities can actually demonstrate the power of these permissionless incentives.
Okay, but let me question that because, and let's take Ridges as an example.
Yes.
Or let's just take any subnet. I don't want to keep picking on any one subnet or other because it's just examples.
Yeah.
But if a subnet does not properly reward its miners, like it doesn't link value creation to the alpha tokens, then the miner should be able to say, screw this, I'm going to go over and make my own subnet.
Correct.
Because I have all the resources, so I could just do this.
This has happened. This has happened many times already.
And so I think once there's higher number of subnets, it's just easier to do that.
Yes.
So there's easier to have competition. And so that's just my only argument for eventually you're going to want to make the cap infinite.
No,
not yet.
I agree with that. I agree with that. I think right now the argument for not is there's a lot of subnets that don't actually have a live productive incentive mechanism with any miner activity at all. And there's a recent protocol upgrade coming soon, which will provide for easier deregistration of those subnets that are really not being utilized properly.
And if I read correctly, you're going to move from 128 to 148.
I think the proposed plan, which is maybe going to be delayed a bit in service of deregistration of a lot of the unutilized subnets that are just not being used effectively, would be to double the subnet slots, so from 128 to 256.
I like that.
But the deregistration is an easier, cleaner kind of intermediary path to basically free up a lot of slack. Again, you've got a few bedrooms in the house, you've got a couple of jobs you're not writing all the time. You use these networks that increase the utilization of those resources, so you have better, more economically efficient utilization of the whole network. And I think that's going to free up more subnet slots and allow people to experiment more and run new incentive mechanisms.
I wonder also if there's a way to create an ability for subnets to buy other subnets. Let's say, I'm going to make it up, subnet 50. I don't even know what subnet 50 is.
Yep.
Let's say subnet 50, they've been working really hard. They have some value. There's a little bit of value to their alpha tokens.
Yep.
And they just can't do it on their own. And subnet 10, whatever that is, says, hey, we'll buy you. And so now they can, and subnet 10 says, we'll buy you for 20% of our subnet. Now all your alpha owners, they own our alpha, 20% of our alpha tokens.
Yep.
I don't know, and I'm not thinking of it correctly. I have to really think about it, but there should be some mechanism where subnets could take over other subnets so the alpha holders can still benefit from the deal making of the subnet founders.
I fully agree with you. I think that would be a really awesome improvement to the Bittensor protocol, and I think that that's potentially something that's in the works. I think that could actually be really valuable.
And then the other question is, how much does it cost to buy a subnet? Let's say I want to buy a subnet. Let's say that goes to 256. And so I want subnet 129. How much will it cost me?
It really shouldn't be too expensive. I think there should be a nominal fee to provide some minimal threshold of quality. You're registering a company, you're probably going to spend a couple $1,000s to get it set up properly. I really believe it shouldn't be much more than that, which is really, I think nominally it should be a few tau. Historically, it's been much more than that. Historically, it's been tens or hundreds of tau to be able to do that, which is more in the neighborhood of tens of thousands of dollars to potentially hundreds of thousands of dollars. And I think that does represent unnecessary friction for a lot of subnet builders, because they'll go out and I put a tweet out recently. I won't mention who, but it's pretty obvious if you look at my Twitter page. There's some investors out there that are very extractive. And in an era where subnets were maybe $100,000 or a couple $100,000, they would go and try and get the sort of same terms as like a Series A investor would, investing $10, $20 million in a company and getting the same ownership, 20, 30% of a company, in exchange for a loan just to register the subnet slot and have perpetual rights to a significant portion of the emissions. I think that hurts the subnet economics. It prevents teams from really discovering the way they can incentivize their own startup and their own team members. Ridges is not one person. It's run by Shaquille and 4 or 5 other folks that are very talented, and they can go and work at any other one of the top technology companies and probably get really lucrative job offers. And so I think that in a world where the Bittensor protocol is more like churning accurately through the highest performing subnets, or the subnets that are really productive, we should have deregistration, actually removing subnets from the ownership if they're not being used productively, and made available for someone else to register and run a new incentive mechanism.
And I would say and correct me if I'm wrong, because I don't really know, when someone registers a subnet, okay, they have to buy the subnet. Do they also have to stake TAO?
No, they basically lock the registration cost in a contract, and that secures the subnet for them. And then they own what's called the cold key. And the cold key gives them control over how the incentive mechanism is designed and deployed and run on the subnet. And they also have some influence over some of these other hyperparameters on the network, like the way the sort of the consensus is reached, which is called kappa, and a few other things. But yeah, it's basically just the cost, the registration cost is locked. And if it gets deregistered, you actually get paid the registration cost back for basically your upfront kind of collateral for staking the subnet.
And why would you do that? Let's say they took up this subnet space, this valuable space and a limited resource right now. And why would you give them back the TAO that they spent? They should take some risk when they start a subnet.
I think that there is a case to be made that that should actually just go into some burn contract or maybe be put back in circulation. I could actually be wrong about this. I think it could actually be put at risk. And for buying the subnet, you are actually just paying that as a fixed cost, as opposed to like a collateralized contract. And when the subnet gets deregistered, you get the capital back.
Like I think of subnet 8, where I think that's the glitch subnet. The trading, trading proprietary.
It's like a hedge fund, prop shop.
I think the miners there, you mine on subnet 8 by giving stock market predictions, and then the better your consistency on stock market predictions, the more rewards you get, because then people are subscribing to glitch to get the top stock market predictions. And I think you have to stake the alpha tokens of that subnet. I could be completely wrong. I think you have to stake the subnet tokens of that subnet in order to make predictions, because you're potentially putting people's money at risk. So people have to know your money is at risk.
So there's a similar design in each subnet, but the subnet owner sets this minimal cost, which is the registration cost to actually mine on the subnet. And it's typically a fraction of a TAO. Most subnets have this in the tens of dollars or $100 range to minimize spam and minimize people that are just mining for malicious purposes, whatever. But the subnet owner also has control over that minimal mining cost, registration cost.
And so I like the fact that with subnet 8, I think it's a pretty high cost. I think it's in the tens of thousands of dollars. And this way you're putting something substantial at risk, which you could lose if your predictions are not good. So the risk is matched against your predictions. And if you lose people money, then you lose your stake. And I'm wondering, because part of what is the demand for TAO actually? Like we're talking all about the demand for alpha. What is the demand for TAO? It's basically the only times I really need TAO is when I'm buying a subnet, or I think validators have to stake also. So you need TAO to be a validator. What other use cases of TAO are there?
TAO is this universal incentive currency, more like a currency than alpha tokens are a currency. Alpha tokens approximate more closely to something like equity, like we've been discussing. But I would say the purpose of TAO is to allow for the liquid incentive across all of the subnets, which is probably the most fundamental thing, right? So the value of circulating TAO creates a large reserve for potential capital inflows or incentive inflows that could be staked into these subnets, which is a fundamental thing that allows these subnets to actually produce an incentive for the miners to produce these commodities.
Right.
So that's a fundamental thing, is like circulating TAO and TAO staked into subnets is the thing that causes the incentives for the subnets to be provided to the miners, the validators, and the subnet owners.
Right.
There's 3 stakeholders. Each subnet has 3 stakeholders: miners, validators, and subnet owners. The TAO itself, if you just stake it to the root network, which over time will eventually dissolve and go to zero. Right now, you're earning 7-8% yield. This is very high yield. This is 2 times higher than the short-dated T-bills will give you for the dollar. A lot of people just stake to the root network. A lot of people talk about there's only 11 or so % of the TAO in circulation, which is like $3-4 billion worth of TAO, actually staked into these subnets. What people are actually not really recognizing is the alpha tokens are inflating or emitting, not inflating, they're deflating actually, but they're emitting in a front-loaded halving schedule in a very fast way from zero in February, because all the subnets had zero emission in February, and now they're on average they have about 2 million circulating alpha per subnet. And so these circulating shares are very small. If I recall correctly, Berkshire Hathaway's total share count is like 1.6 million or around there, like less than 2 million. But each share is worth $700,000-$800,000. But these subnet alpha tokens will emit at a total circulating supply eventually of 21 million, right? They're all finite, and you can't print more of them. You can take some out of circulation, which would increase the scarcity, which would increase the value discovery and price discovery. But only 6 months into dynamic tau have there been around 2 million circulating tau per subnet. If you fast forward another year, we're likely to be in a situation where there's 5.5 to 6 million alpha circulating per pool. And so even if it's something I was mentioning over at breakfast, a lot of people don't fully recognize this. Even if the alpha prices denominated in tau are flat as of today, and obviously the tau price stays flat, which could go down, could go up. We don't fully know the future. The valuation market caps of all of the subnets that have around 2 million circulating in a year to get to 6 million will grow by 3x, right? Because 2 goes into 6 3 times. So you're going to have a 300% appreciation of the market cap of a lot of the top alphas just by having flat price, right? And so that does not include more tau getting staked into the subnets, and that does not include the price of tau itself appreciating.
Unless you look at just the fully diluted value all the time. So I tend to look at the fully diluted value all the time.
I'm with you. A lot of people disagree on this. A lot of people think we're crazy, and they're like, why are you looking at the FDV? Because they look at market cap. And I think this is a mistake. What a lot of people say when they defend the point of view of looking at market cap versus at FDV, and for the audience, market cap is circulating alpha. FDV is the fully printed inflated alpha, which is 21 million. It's the same case with Bitcoin and with tau. The difference with alpha tokens is that they emit faster. The speed at which the alpha goes into the pools just programmatically, even without any staking at all, is around 1.5 to 2 times at most faster than the emission of tau. And so if you look at the block emission rate per day in the first halving for tau and for Bitcoin, and the first 4 halvings from first 4 years from 2009 to 2012 for Bitcoin, it was 7,200 Bitcoin per day. That's the same as tau, 7,200 per day, right? So every year for the first 4 years, it's around 2.6 million per year.
Man, I wish I'd been mining Bitcoin then, but it is what it is.
We have another couple more months for this for tau, but you don't mine tau, you mine the alpha tokens, which are represented in tau. With the alpha tokens, because they're inflating faster, you'll get to 90% circulating of the 21 million, which is 19 million plus, in about 7 years. So it's actually not a long period of time to reach fully circulating alpha in the pool. Now, if you're a day trader, or if you're like a hedge fund or an impatient person that does nothing value related and you're just pure speculation, sure, you can look at you can look at market cap, and you can look at the circulating supply as the measure of how this thing's priced. And you can look at the charts and you can look at all the candles and all this crazy stuff.
That's insane.
I don't look at any of that. I'm a long-term investor because I've been conditioned that way with illiquid private equity venture capital style investing. But with alpha tokens, I do believe if you're focused on the quality of the team and the long-term durability of what they're producing and their ability and their potential as a team to produce a really incredible product and to disrupt a market and to make that product successful commercially, you should be looking only at the FDV, because the FDV is a great proxy. And even with the FDV of something like Ridges, right? I can tell you that Ridges team, if they were a venture funded startup and they reached that result with around the same amount of people that allowed them to reach that result, which is again 100 people we're talking about in the mining graph, they would have raised hundreds of millions of dollars and they would be worth many billions of dollars. What is the FDV of Ridges today? It's 500 million. So
it's only 500 million.
So it's a significant, very significant discount to the likely valuation of what a venture firm would price it at. Now, that is not how I would recommend people think about valuations, because I do strongly believe we're in a very inflated environment with a very bubbly, frothy way of pricing companies that actually have no revenue and have no products.
You're not saying the subnets are overvalued. You're saying these frothy AI companies they should, like Anthropic just raised money at $183 billion valuation.
I would say the early stage companies that VCs are pricing at many hundreds of millions, if not billions of dollars, that have no users, no products, no revenue, but just a team that might be able to do something interesting, that is extremely dangerous, and most of those companies are not going to make it.
What the exact same thing could have been said in 1999 about internet companies. And what was
Most of those companies did not make it, though.
But they did not make it. But I would say that was a period of great price discovery.
Correct.
So, like, we didn't know pets.com was not going to make it. We didn't know Amazon.com was going to make it. Barron's had a famous cover, Amazon.bomb.
Yep.
Everybody thought Amazon was going to go out of business.
Yep.
So it was this period where something was going to be worth trillions. We just didn't know who.
Yes.
And so some of these AI companies may succeed.
I agree.
But yes, I would say the average is probably overvalued at this point, and probably just because nobody knows what Bittensor is, the average subnet is probably undervalued.
Yes.
Some are probably correctly valued, some are probably valued too high.
Correct.
But some are certainly grossly undervalued. Like, we're talking about a difference between, let's say, 50 million is the average valuation of the top 50 subnets, and versus $100 billion for these top AI funded companies. That's a huge discrepancy.
Yeah, it's a giant gap. But even for the ones that are not OpenAI and Anthropic, because there's really effectively two companies that heavily skew the numbers in terms of just all of the AI company financings, Anthropic and OpenAI. It's just two companies. If you take those two companies out, you still have probably over 200, 300 companies that are unicorns, or
billion-dollar companies,
multi-billion-dollar valuations. And I would argue the vast majority of those companies are not going to make it. And there's only going to be maybe 10, maybe 15% generously that have exits and outcomes that match the valuations VCs gave. And some fraction of those that actually end up producing really valuable products and services that are sustainable and allow for those companies to exist for many years to come without relying on venture capital as a subsidy. And so what a lot of people say this of the Bittensor subnets is, I mean, just using Tao as a subsidy for producing something. Guess what? The vast majority of these AI companies are much less efficiently producing stuff at a massive subsidy thanks to venture capital for generating very negative gross margin businesses, which is not necessarily a bad thing. But in a sort of a median or average sense, looking at this, it is incredibly underperforming how real companies are valued.
And to your point, so I'll give you an example. I'll give you a story. One time I started a company. I was going to be a wireless software. This was before like iPhones and mobile phones. I was going to be like a wireless software company, raise money from Henry Kravis, Leo Hendry, CMGI, Allen and Company, and a bunch of VC firms, raised money at a $15 million at a $15 million valuation, and then bought another company for $15 million in equity. So my equity was worth zero the day before I raised money, but suddenly I raised $15 million at a $15 million valuation. So I was able to buy another company with my equity. I basically, and this is the point about these alpha tokens, and this was 20 years ago, I was able to create something that looked like cash out of nothing. It was equity.
Yes.
And so people are saying, oh, the alpha is not worth anything, blah, blah, blah. Again, I was able to somehow create some value creation because other VCs said, oh yeah, his equity has value. So now he can use that value, that equity as money instead of using cash to buy a company. It's the same thing with these alpha tokens. As soon as the alpha is linked to value creation, then amazing things are going to happen they could buy companies with their alpha. They can buy resources with their alpha. They already are buying resources with their alpha using the miners.
Yes.
So this is going to change the game as this happens.
I think that there's also evidence of subnets using the alpha they have in exchange for other subnets alpha or commodities. So for example, one thing that Ridges actually does is they use their alpha to purchase compute from other subnets.
That's great.
Like Shoots and Targon, to have better, less expensive compute to actually run their evals on their models. And one thing that Shaquille mentioned to me was their cost of compute is something like 1/20th or 1/30th what it would have been otherwise had they paid Anthropic.
That's
or
amazing.
paid one of these AI compute companies, because Bittensor actually provides a better price discovery of these assets. But again, we do need to find a place where there's sustainable and predictable mechanisms of representing the value back to the alpha outside of the Bittensor ecosystem. And if we can connect that to normal businesses that may know a little bit about Bittensor, and they're like, wow, this is extremely impressive what you've created here, but they just want to buy a great product. And they just want to use that product and pay a subscription fee or put a purchase order together and wire money for a license fee or whatever. That sustainable mechanism needs to be connected somehow back to the alpha. And I'm very confident as well the teams are going to figure out how to do this. I think the more we talk about it and demonstrate examples in the community, the better people can understand it for sure.
Yeah. So yeah, maybe next episode we'll talk about a few more subnets that we haven't talked about before. We haven't done that in a while. Just 'cause I just every day I find new subnets that I'm amazed at what they do. And we've talked about Yanez, Bitcast. And by the way, after we talked about Yanez and Bitcast, they both ended up doing appearances on a bunch of other podcasts. So I think
Nice.
we're shedding light on the subnet community. And there's so many fascinating ones out there. But I feel like this is almost like my Bittensor therapy session. Like I have all this angst and all these problems, and then we talk it out, and then I see the light, and there's more hope than I had even before about the potential for this. But I always hate to sound like I'm shilling Bittensor or saying, oh, everybody should buy Tao. Don't buy Tao if you don't want it. It's going to survive on its own. But I'm just happy for myself that this is where I'm placing my financial resources and a significant amount in this ecosystem.
I feel very much the same, and it's always a pleasure to do this with you, James, and it's awesome to do this in person.
Yeah, in person. And we met in Paris 3 months almost to the day ago. So good doing this is episode 7 of the TaoPod.
Yeah. Hope everyone enjoys it.